I guess the other point as well is that emerging market central bank buying, although India and China have both bought gold, but emerging market central bank buying is much broader than the spread of consumer demand for gold. So there's lots of emerging markets which perhaps don't consume as much gold at a retail level, but have bought good amounts. And I'd point to Poland, for example, Hungary a few years ago. So yes, you can't ignore India and China. We pay more attention to those two markets than probably any other market. But other emerging markets have been really important too. I mean, I guess the biggest news in India last year, which really did prompt some very strong demand in the second half of the year, was the unexpected cut in import duty that took place at the beginning of July. I mean, gold suddenly got 9% cheaper overnight, and Indian purchasers who had stood back in the second quarter after the gold price started to really rocket came into the market and bought good amounts in the third and to a lesser extent the fourth quarter of 2024. Underlying demand in India remains decent, but like most markets, we see when demand is dominated by jewelry demand, then high prices do tend to result in less volume.
John, if I've understood you right, when you said the pattern of demand, particularly in emerging markets like India, is changing with the rise in investment demand, which is over and apart from the demand for jewelry. So are we and buying by central banks? So what you're suggesting is that there is a structural shift in the nature of demand, right?
I think that's right. And I think we've seen that over the last 30 years. 30 years ago, the gold market was dominated by jewelry demand. Something like 80%, 90% of global demand was from jewelry demand. And Western jewelry buyers were really important. Europe was a huge market. The United States was a huge market. Japan was a huge market. So emerging markets were a lot smaller components of the gold market back then. Now, if you look at where we are now, I mentioned before, nearly 75% of demand is coming from emerging markets, but the breakdown of total demand globally has shifted. Now we're in a situation where investment demand over the last 10 years has been just a bit higher than jewelry demand, about 42% versus 37%, something like that. So this is a market where investment demand has become much more important. It's a market where central banks have been buying now for the last 15 years, but prior to that, they'd sold gold for 21 years in a row. I mean, the only thing that doesn't really change on the demand side is industrial demand or technology demand for gold, which has always been about 6 or 7 or 8% of total demand for gold. And even though you see positive headlines about how tech demand for gold is being boosted by artificial intelligence, that's true. But over the longer term, we've always seen industrial demand for gold at around current levels in proportionate terms. So the big shifts that have happened is that gold demand has moved towards emerging markets and to become more balanced, split between jewelry demand and investment demand.
Can we then stretch this argument to ask the question whether gold is emerging as an alternative financial asset in a country like India? Because I asked this about India because we are seeing an increasing trend of financialization of savings, which is, unprecedented, what we have seen in the last 5 years. John, to go back to your opening remarks where you said one of the factors influencing this sharp rise in gold prices is global uncertainty and geopolitics. Can we also assume that this price run is also warning all of us that the global economy is also not in a good place?
I'm not sure that it's saying that the global economy is not in a good place. I think it's saying, though, that the risks are that there could be a deterioration, and perhaps a deterioration greater than is being factored in by other financial markets. We have seen a bit of a correction in some equity markets, particularly the United States, but also valuations remain pretty high. Gold price is telling me that risk and uncertainty is high. The equity market's saying it's not. I tend to believe the gold market a little bit more because it seems to be a little bit more international in the way that it takes into consideration these risks, whereas particularly the U.S. equity market is driven very much by domestic sentiment. And to be frank, I'm not quite sure how much America understands about the rest of the world, particularly at an individual level.